the topic for today is on stablecoins. We'll start by going through a broader overview of the stablecoin landscape, its beginnings, and where we're at now following the 2021 bull run and subsequent bear market that we've been through the past year or so. The current state where we are, some of the innovations that have come into the market over the past few months, the growth there, what's the drivers behind the current state, and then putting into place all of these developments in the industry. We'll give some thoughts on the path ahead for decentralized stablecoins. So before getting started, quick update about Into the Block. This is tied to some of the subjects I will be talking about today. So we're about to launch, it's been in development for a while, Into the Block Aave Go Risk Radar. So these are metrics covering risks, cover on Go, the stablecoin from Aave, the liquidation, solvency, bad debt risks, price stability, and more. We'll be launching that officially towards the end of this week, early next week. I'll be sharing some of the indicators I will have there throughout the presentation. So we're excited to launch this in collaboration with Aave. Similarly, we're also launching for Curve, the risk radar. Unfortunately, Curve did get hacked just a week ago. So we're waiting for the dust to settle a bit before releasing this, but we're also very excited to be launching some metrics here covering indicators for liquidity providers and traders to mitigate losses from many economic risks that are often overseen in protocols like Curve. We also released a piece on DeFi micro primitives. Jesus, our CEO, and this will actually be the webinar topic for the next webinar. So we'll share more information on that towards the end. All right, without further ado, let's get into our main subject. So just to make sure we're all on the same level, I'm assuming many of you already have a decent understanding of the space, but just to make sure, I would categorize stablecoins within two main segments, custodial and non-custodial. Some people would call it centralized or decentralized. The reality is that some of the decentralized are not as decentralized. So I prefer the term non-custodial, even though I'll be referring to both with the same term, so decentralized or non-custodial. Pretty straightforward. Those that are custodial are held by the collateral assets are held by entities such as Tether or Circle for the case of USDC. For the non-custodial, it's a bit more complex. They can rely on either collateral or mechanisms to preserve the pegs. So the main two types of stablecoins there are the collateralized debt positions, pioneered by Maker and DAI, whereby you provide a collateral asset that is over collateralized, so you provide more collateral than what you're borrowing, and the borrow is effectively you're minting a new type of money that is pegged to the stablecoin, typically $1, through diverse mechanisms, but since it's fully collateralized, it typically relies on liquidations to preserve that value. And then on the more experimental side of things, there's algorithmic stablecoins, which rely on market forces and some built-in features to dynamically adjust towards the peg. And so with centralized stablecoins, that's how the space got started back in 2014, initially called as Realcoin, then renamed to Tether in November 2014. The idea was that in crypto exchanges, you could already access fiat, so dollars, and trade. That was a primary method to trade Bitcoin, was buying it with dollars in some of these markets. But there were some friction points, moving the fiat into the exchange, and then also fiat can't be sent internationally in a trustless manner. So in the Tether white paper, they outline how they can have a token pegged to the dollar, to have some of the aspects of a cryptocurrency, but also the ease of a medium of exchange that is pegged to a more stable value than crypto, especially back then when it was even more volatile. So that began in 2015. It got launched initially just on Bitcoin, expanded to Ethereum in 2017, and a lot more blockchains since then. Then in 2018, USDC got launched on Ethereum, also expanded to many more blockchains over the past few years. And BUSD in September 2019, initially on Ethereum, and then Binance Smart Chain shortly after. So those are the three main centralized stablecoins. There's a few others that have gotten some traction. And in the 2020 to 2021 bull market, they absolutely kicked off. So this is a graph showing the market cap, aggregate market cap between USDT, USDC, and BUSD that went from 5 billion in the beginning of 2020 to about 150 towards March of 2022. And then we began contracting significantly down to 113 billion. So it's lost about 25 billion in market cap over the past few years. And it's been, quite a downtrend. Particularly USDC and BUSD have been taking the bulk of a hit, since USDT has taken a lot of USDC's share post the SVB Silicon Valley Bank collapse. And the decentralized stablecoin landscape is a bit more complex. MakerDAO launched DAI initially in December 2017. It, of course, is the largest and first in the space. And I would classify the other stablecoins on like the whole decentralized stablecoin landscape within this axis. So essentially, it's either fully collateralized or fully algorithmic. And it's either externally backed or endogenously backed, which essentially means it's backed by itself. And so in the upper right-hand axis, we have MakerDAO and LUSD, which are externally backed. So they're not minted with, MKR tokens or the Liquidity token. Instead, they're minted mostly with ETH in the case of LUSD, and to a certain extent with USDC for DAI. Then on the left, we have some that are externally backed, such as Frax, which is backed mostly by USDC as well, but it does have some algorithmic components, especially in the Frax v2 version. Its price isn't fully backed. It oscillates depending on a potential premium, and mints a portion to be able to keep the peg, which is a slightly similar mechanism to Terra, though significantly more backed. And that brings us to the lower left quadrant, which has been by and large unsuccessful. We have fully algorithmic stablecoins that are not backed by anything, such as Ampleforth, which just led to supply contraction and expansion, trying to preserve the peg. Interesting experiment, but arguably not successful. And then UST, of course, which infamously collapsed. It was endogenously backed, so that in a way that if the peg was below 1, it would mint Terra to be able to preserve that peg to get the value of 1. But what happened was that when there was an overly high amount of Terra entering the market, it was too high to be able to keep the peg eventually. And so it dove to almost 0 essentially. And finally, we have also on the experimental side, though a bit more successful, Olympus DAO, which is not really stable, even though it targets some type of stability. And it's also interestingly endogenously backed, but in this case by Liquidity itself. So it pioneered the protocol-owned liquidity approach that still remains to this day. And in 2020, 2023, probably the most representative chart for decentralized stablecoins is the market cap of USD. So all together, the decentralized stablecoin space got to about 40 billion or so. And we saw Terra USD be the main player towards the end of the bull market and catastrophically collapse, losing most of the market cap that it had built. Then DAI and Frax also lost a lot of their market cap, particularly accelerating after the SVB collapse, since they also had USDC backing, and USDC itself has been contracting after the Silicon Valley Bank incident. And so the hit that the decentralized stablecoin space took was even larger than their centralized counterparts, losing about 75% of their market over the last few months. And now I want to dive into 2023. Where are we now? What's the current landscape, and how are things evolving towards the next few months and years? So I would argue that the worst in the decentralized stablecoin space is likely behind us. We got some type of proof that endogenously backed and algorithmic stablecoins, as I was just showing, haven't been successful. So instead, the space has been doubling down on what is actually working. So collateralized step positions such as DAI and a few other new entrants are making the space grow even more. And they're taking some twists to make things more attractive and also to be able to compete with USDT to gain more market share. So there are a few things that are driving interest in decentralized stablecoins. One is the move towards DeFi in general, which was accelerated post the Silicon Valley Bank reckoning, where more activity has been driving to decentralized stablecoins. Then, perhaps more importantly, recently we've seen the real-world assets take off within DeFi, particularly through the Treasury's yield, which can be accessed on a permissioned or a permissionless manner, as I'll talk about briefly. And then also liquid staking derivatives, or so-called LSDs, have seen remarkable growth and are helping drive stablecoins forward, as I'll get into. So let's talk about USDC crash briefly. So this is one of our curve indicators that we'll be launching. When it was discovered that part of Circle's collateral was held in Silicon Valley Bank, naturally there was a lot of panic, and the price of USDC crashed significantly. But we can see here that it crashed a lot harder against USDT, which didn't have exposure to Silicon Valley Bank. And then versus DAI, it also depegged, but DAI itself is partially backed by USDC. So DAI also depegged versus USDT, and it created this situation where trust was sort of broken in USDC, and it revealed the hidden issues that DAI had from being backed by USDC itself, arguably being less decentralized than some alternatives. And it had some ripple effects that we continue to see. One token that actually benefited significantly from this outcome was Liquidity USD, LUSD, which has been one of the largest increasers in terms of market cap in 2023. So it's up over 50%, and we can see here that right after the USDC crash happened, that the DAI market cap briefly jumped, but then decayed quickly and is even lower now than it was. Whereas the LUSD market cap took a significant amount of share and increased even further, while USDT also benefited, attracting more billions, but growing less so in a percentage terms. And what we're seeing is the decentralized stablecoins trying to become more competitive by taking different approaches to USDT. So I'll dive into some of these protocols specifically. the main decentralized stablecoin to this day is still DAI, and they've been increasing the incentives to hold DAI through this thing called the DAI savings rate. So this was increased to 3.49% a few weeks back, and to 8% just this past Sunday. So it's already live at 8%. And how that works, it might be a bit confusing, but I'll in a brief summary, the 8% is provided by Treasury's yield, which they pass a proposal to have some of their collateral custody there, earn the Treasury's yield, which is about 5.5%. But it is able to get to as high as 8%, since not all DAI in circulation earns this yield. So that's why it begins at 8% up until 20% utilization. So if 20% of the DAI is in DAI savings rate, up to that point, they will be able to subsidize an 8% earnings or savings for depositors. And then it drops to 5.6%, which is more in line with the current treasury markets. And that has worked significantly, as I'll get into briefly. Then we have Frax, which, after the Silicon Valley Bank event, is revamping the whole component of how it works. And it's launching in August, supposedly, towards the end of the month. A new system in Frax v3 where USDC is no longer the core component. More info should be coming on this soon, but that much we know. And then we have, other than LUSD, which I already covered, we have some new entrants which have been making significant improvements over the past few months. One that is lesser known, though it's still quite large market cap, is this stablecoin called EUSD from the protocol Libra. And why it's been able to grow so fast, it launched just in April, and by being able to borrow at 0%, they mint EUSD at 0% and take a fee from the staked E, and liquid staking in general collateral, making it a less friction to be able to borrow. And then we have CRV USD from the Curve team, which has a unique self-liquidation algorithm and also a vast liquidity network that is able to attract liquidity. Within just a few months, it reached almost 100 million. It's come down a bit since the Curve hack. And Aave Go, which is now about 18 million. This is a bit outdated. And the core selling point is that you're able to borrow at a fixed rate of between 1 and 1.5%, built on top of Aave v3, which already has a decent amount of liquidity as well. I see a question from Crispian. I'll dive into that towards the end of the webinar, since it seems to be less related. And now onto one of the main drivers for decentralized stablecoins in the past few months is the advent of real world assets and yields coming on chain. One protocol that has been behind this is Undo Finance. It's permissioned, so it's not fully decentralized, but they custody treasury yields by having those collateral assets in short-term treasuries and giving those yields to OUSG holders. So it already has access to that. And we've seen significant growth, within a few months, from 0 essentially to 158 million. And in a more permissionless manner, as I mentioned, DAI is effectively redirecting their earnings from treasuries to any DAI holder. So in this case, DAI doesn't have any KYC, and it's also more composable, has more liquidity throughout DeFi. So we saw that, this weekend, as the DSR was increased to 8%, about 600 million in DAI entered the DAI savings rate. And I believe about 400 million new DAI was minted. So we're seeing the proposal already take a lot of, drive a lot of attention into DeFi. even though there's some changes that Rune is already arguing to bring that lower. And then finally, we're seeing the liquid staking derivative Fi or LSD movement that has already surprisingly grown massively as well. So Libra already covered, which is mostly backed by liquid staking derivatives and zero borrowing cost. Then there's also a protocol called Raft that has a very similar approach with their R stablecoin. Between them, they have about 400 million in total value locked, which, you know, launching in just a few months is quite significant. And it also further validates the proposition of liquid staking derivatives as collateral. We see that same pattern take place in Go, which isn't exclusively backed by liquid staking derivatives, but, you know, instead those that mint Go get the ability to choose what collateral they put into the protocol. And by and large, liquid staking tokens such as Wrapstake ETH, Rocket Pool ETH, and Coinbase ETH make up a very large chunk of it. It started at about 50%, as we can see here, and now it's holding up at about 40%. This is data from our upcoming Go indicators, by the way, and it further validates the proposition of how liquid staking derivatives is also helping propel stablecoins forward. And finally, CRV-USD is a very similar, even more concentrated in liquid staking tokens, with, you know, currently, this is as of this morning, 52 million out of the 70 million in supply. Most of the collateral for CRV-USD is coming from Wrapstake ETH. So now I want to talk, you know, put everything in place, all of the improvements that have been going through the industry, the regulatory environment, and where that leaves us for the decentralized stablecoin landscape for the next few weeks and months. So I believe that a lot of the, you know, improvements that we discussed in the last section are the seeds being planted for future growth for decentralized stablecoins. You know, we have now access to high treasury yields on chain, which wasn't the case just a few months ago. People can now, through DAI, get these stablecoin yields, and, you know, it arguably makes it at least par, if not higher, than treasuries. So there's less of an incentive to migrate from stablecoins back to TradFi, and it's significantly more frictionless. So it could also bring more people to, you know, buy treasuries indirectly, where they might have not done so. You know, if you're in Venezuela and you want access to treasury yields, you're probably more likely, or at least easier to access through something like the DAI savings rate than it is to buy bonds yourself, as it's the case across most of the developing world. Then in parallel, we're also seeing low borrowing costs, as I mentioned, through Aave Go and Libra EUSD, which makes a very good complement to the high treasury yields, since you can effectively borrow in one and deposit into the other. And in a broader perspective, we've already seen DeFi grow significantly and putting some pressure on centralized crypto companies. So this is reflected in the spot trading volume between decentralized exchanges and centralized exchanges, which just recently hit an all-time high of above 20% for the first time. And I believe there's less information for centralized lending, since Celsius, BlockFi, etc. were all opaque, but they went to zero, while Aave and Compound, etc. are still operating. So the percentage of DeFi lending versus centralized lending is also likely to be even higher. So these are tailwinds likely to continue to build momentum for DeFi and help it attract more liquidity and users over the next few months. And that drives me into the bull case for decentralized stablecoins. With the seeds that have been planted, I think it's not far-fetched to believe that we may see an on-chain credit boom take place over the next few months, Q4 of this year, perhaps more likely next year. So we already have most of the innovations launched. It's more a matter of getting traction at this moment. So one thing that can help facilitate that is leveraging composability. So for instance, having the S DAI, which is the DAI that earns the DAI savings rate, as collateral in something like Aave to be able to borrow against that. So it's effectively borrowing against treasuries indirectly. I think that will be a massive boom that we'll see out of that, since you can do that carry trade, borrowing against treasuries at a lower rate and looping that. I think we're likely to see a lot of growth coming from that. Then we'll have trustless collateralized depositions, such as Go as the loans, because they can preserve a low borrow rate. And in the other side, the somewhat custodial stablecoins like OUSG and DAI to access the real world asset yield. So this will have a synergy between each other, symbiotically benefiting growth in both. To that point, actually, since the DAI savings rate increased, we already saw the Go market cap almost double, which already points to this demand. Then on a separate point of view, the Fed paper from yesterday is already giving some clarity on stablecoins. And if we do get even more regulatory clarity regarding stablecoins and DeFi in general, I think we're likely to continue to grow over the next few months. And finally, on a more experimental front, we're also seeing some Forex expansions beyond the dollar, beyond just fiat, also into gold and other commodities as a potential course for expansion for DeFi and decentralized stablecoins in general, although that's likely even further down the road. And the bear case is, we're in a bit of a lull for the market in crypto as a whole. There's less volume, less activity. It's also summer, so many of them in vacations. So potentially, this lull can extend a bit longer. You can argue if it'll extend, just this year, or if we'll see an extended crypto winter. But needless to say, if that does materialize, it'll be negative for the decentralized stablecoin space. There are also some potential challenges for real-world asset yields. So, for instance, DAI savings rate, which is indirectly treasuries, you could argue that, at least the government could argue that a terrorist could potentially access treasury yields through the DAI savings rate, which of course people in the government will likely go against. So I'm expecting some friction there. I don't know how soon, since the DAI savings rate at these levels are relatively new phenomena. So it is possible that we'll have some issues there with the real world asset yields, and that could put some headwinds on the space. Then there's also the risk that the regulatory clarity doesn't materialize and that we're sort of stagnant space. And it's also worth noting that the SEC recently went out after the protocol Barnbridge, which is a small DeFi protocol. But there's a possibility that after them, they go for larger and larger DeFi protocols, which creates friction for the DeFi space in general. So in conclusion, stablecoins, along with the market, have contracted significantly. Decentralized stablecoins in particular were hit the worst with the Terra collapse, USDC troubles showing some of the cracks in the system, and decreasing credit demand, also putting a hit on collateralized debt. In the second half of 2023, we've begun to see a bit of a resurgence. A lot of these improvements have been worked on throughout the beginning of the year. And now, through the access to real world asset yields, low borrow costs and introduction of new stablecoins, we're seeing this resurgence that I expect to last towards the end of the year, and potentially drive us towards the bull case that I pointed to, where there's a possible on-chain credit boom taking place towards the end of this year, beginning of the next one. So all in all, I think we're setting the stage for continued growth in the space, and it's certainly quite interesting. And I encourage you guys to all keep an eye on the growth here. So that's it for today.